Welcome to our Retirement Basics webinar. I'll be your moderator for today's session. We are going to learn about the basics of retirements today, and this program is sponsored by IBM SECU Financial Planning and Investment Services. We have our Georgia financial advisor, Stacy Jamison, here to present with us today. If you'd like to go ahead and contact Stacy about any questions that you have during the session, please go ahead and go to ibmsecu.org, choose Services, then Financial Services, and complete the form at the bottom of the page. For now, let's go ahead and turn it over to Stacy to talk about today's topic. Stacy?
Thank you, Stephen. Well, let's get started on retirement basics. When you close your eyes and imagine your own retirement, what do you see? Most of us imagine retirement as a happy time, a reward for a lifetime of hard work, full of possibility and potential. Many of us look forward to pursuing hobbies and traveling, while others may see the opportunity to go back to school or to start a new career or business. We have a good reason to see retirement in a positive light. After all, Americans are living longer, healthier lives than ever. In fact, for some of us, retirement will make up 1/3 of our whole lives. Of course, this means that our retirement assets will have to do more for us over a longer period of time. This makes planning for our retirement essential. If you were going to drive across the country, you wouldn't just get into your car and start driving, would you? Of course not. You'd map out your trip and spend time packing and preparing. Nevertheless, a remarkable number of people don't take the time to map out the 30 years or more that it can realistically take to achieve their goals. We're going to spend the next 25 minutes or so talking about how you go about establishing a plan for retirement. It may help if you think of retirement as a destination and your plan as a roadmap that will get you there. In constructing the roadmap, we'll talk about why it's so important that you start planning now. We'll help you think about the answers to some basic questions. What kind of lifestyle in retirement do you want? Where do you want to live? How long do you expect retirement to last? We'll also talk about how to come up with an investment plan by crunching some numbers. The role of tax-advantaged retirement vehicles, annuities, some general investment considerations, how you can protect your plan against undue risk, and finally, a plan implementation. At the end of this, connecting the dots, you'll have your roadmap. Many people assume that it can hold off saving for retirement and make up the difference later, but this can be a very costly mistake. The further off retirement is, the more time your investments have the potential to grow. Waiting too long can make it very difficult, and only a few years can make a big difference in how much you'll accumulate. For example, invest $3,000 every year starting when you're 20 years old, and if you retire after age 65, you'll have accumulated almost $680,000. That's assuming a 6% annual growth rate and no tax. If you wait until age 35 and start saving $3,000 annually, you'll accumulate only about $254,000. And if you wait until age 45 to start saving, you'll accumulate only about $120,000 by the time you retire. Now, this doesn't mean that there's no hope if you're 50 years old and you haven't set aside anything for retirement yet. It just makes it all the more important that you implement a plan today. Before you can start planning for your retirement, you need to ask yourself 3 basic questions. What kind of retirement do you want to plan for? When do you want to retire? And how long will retirement last? Let's look at how to go about answering these questions. A few minutes ago, I asked you to close your eyes and picture your own retirement. Let's carry that thought forward a little. Whether you picture yourself on a golf course, a yacht, a hammock, or simply in your own living room, many of you probably imagine some degree of financial independence. Certainly, a few of us even imagine ourselves as a financial burden to those we love. To a large extent, maintaining financial independence in retirement depends upon the lifestyle we want. Can you describe the retirement lifestyle you'd like? Does it include extensive travel? Do you imagine yourself living in your current home, or are you downsizing to a smaller home, or perhaps purchasing a vacation home? Would you like the opportunity to provide financially for your children or your grandchildren, or even your own parents during your retirement years? In a moment, we'll look at how you might go about determining the cost of the retirement you want. But first, let's look at other basic factors that will impact your calculations. Have you thought about when you'd like to retire? It's important because the earlier you retire, the shorter the period of time you have to accumulate funds, and the longer the period of time that those dollars will need to last. Although you can retire any time, most people wait until they're eligible for Social Security retirement benefits. You can't start receiving Social Security benefits until age 62, and the earliest you can receive full Social Security retirement benefits is age 66 to 67, depending on the year you were born. Also, you're not eligible for Medicare health coverage until age 65, so if you want to retire before then, you'll want to plan for private health insurance. As we discussed, the earlier you retire, the longer the period of time your funds will need to last. But how long should you plan on your retirement lasting? Well, according to the National Center for Health Statistics, the average 65-year-old American can expect to live for another 19.3 years. Keep in mind as well that life expectancy has increased at a steady pace over the years and is expected to continue increasing. In fact, in the year 2013, there were over 67,000 Americans aged 100 or older. The point I want to make is that for many of us, it's not unreasonable to plan for a retirement period that could last for 25 years or more. Now that we've talked about the type of retirement lifestyle you want, as well as the general time frame, it's time to crunch some numbers to estimate the amount of money you'll need to make it all happen. First, we'll discuss how to estimate your future retirement expenses. Then we'll talk about projecting your retirement income. This will allow you to identify your retirement income shortfall, or what I like to call your gap. Accumulating enough funds to close this gap is your ultimate investment goal. We'll talk about how, by making some assumptions, you can calculate exactly how much you'll need to accumulate. Finally, we'll talk briefly about the impact that inflation will have on your calculations and your plan. Let's start with estimating expenses. You've probably heard some general rules of thumb. For example, you may have heard that you should plan on needing somewhere between 60% and 90% of your pre-retirement income when you retire. Using such a rule of thumb is easy, but often not very helpful. Instead of basing your estimate of expenses on a percentage of your income, focus on your actual expenses today and think about how they will increase or decrease by the time you retire. Additionally, if the retirement you want to plan for includes extensive travel or hobby activity, this is the time to associate a corresponding dollar cost as well. Obviously, the further away from retirement you are, the more difficult it is to make an accurate projection. Nevertheless, you should detail every potential expense that you can think of. In listing your expenses, here are some things to consider. Your housing costs may decrease if you will have paid off your mortgage by the time you retire. You'll probably pay less in overall taxes, specifically income taxes and Social Security taxes, once you stop receiving a paycheck. You'll probably eliminate some costs associated with your current job, such as commuting, clothing, dry cleaning. You're likely to pay more, though, in health costs, particularly if you retire before you qualify for Medicare. You're likely to pay more in general entertainment expenses like dining out. And depending on the age of your children and or your parents, you may want to estimate and include projection costs for their support, education, healthcare, and or housing as well. Now let's consider how much annual income you can count on during retirement. Traditionally, retirement income has been described as the three-legged stool comprised of Social Security, traditional employer pension income, and individual savings and investments. With fewer and fewer individuals covered by traditional employer pensions, though, the analogy doesn't really hold up very well today. It's important to get an estimate of the amount of Social Security benefits you'll be able to receive in the future based on your earnings record. You can go to www.ssi.gov and you can sign up for My Social Security account on the Social Security website to view your Social Security statement online. Your statement contains a detailed record of your earnings as well as estimates of retirement survivors and disabilities benefits and other information about Social Security. If you don't sign up for an account, you'll receive a statement in the mail every 5 years from age 25 to age 60 and then annually thereafter. You want to pay attention to your benefit estimate for a couple of reasons. To make sure that the information Social Security has is accurate and to understand how much you can expect to receive in retirement benefits. The good news is that Social Security will provide a monthly benefit each and every month of your retirement, and the benefit will be periodically adjusted for inflation, which we'll talk about in a moment. The bad news is that for most of us, Social Security alone isn't going to support the retirement we imagine for ourselves. For example, the quick calculator on Social Security's website tells us that an individual born in 1957 who currently earns $70,000 a year can expect to receive somewhere in the neighborhood of $24,000 annually at full retirement age, which in this case would be 66 and 6 months. Of course, your actual benefits will depend on your work history, earnings, and retirement age. The point is that Social Security will probably make up only a portion of your retirement income needs. With fewer and fewer individuals covered by a traditional employer pension plan, that leaves us just with one other leg of the stool for most of us to rely on, our individual savings and retirement investments. Let's pause for a moment to try to tie some of this together. We've talked about estimating annual expenses in retirement, and we've talked about estimating annual income in retirement. With very few exceptions, most of us are going to find that there is a significant gap between what we think we're going to need to have for retirement income each year and what we think we're going to need each year. This gap represents the amount of additional income that we're going to need to make up through savings and investments. For example, if we estimate that we're going to need $50,000 each year to have the retirement lifestyle we want, but project that we can count on Social Security to provide only $20,000 each year, we've got a $30,000 shortfall. And if we're planning for a retirement that lasts 25 years, we'll need $30,000 each year for 25 years, a total of $750,000. Your retirement investment plan should have one primary goal: accumulate enough assets by the time you retire to satisfy your projected income shortfall for all the years of your retirement. But how do you determine the amount you need to accumulate? Actually, once you quantify your income shortfall for each year of retirement and you know how long a retirement period you want to plan for, it's a straightforward financial calculation. Keep in mind that even though you'll be drawing from your investment fund each year of retirement, the remaining funds will still be working for you and hopefully growing. So you need to assume a reasonable rate of return, for example, the rate at which you believe your untapped investments will grow. Remember, though, that this is an estimate only and there are no guarantees. Your investments could actually lose money. For example, let's say that I determine that I'm going to need an additional $30,000 for each year of my retirement, and I want to plan for a 25-year retirement period. If I assume that my unused retirement funds will grow at 6% each year, I'll need approximately $384,000 at the time I retire. How you should go about building that lump sum is the subject of the remainder of our discussion. Before we move on to that, however, we have one more number crunching topic to discuss: inflation. Inflation has the effect of reducing the purchasing power of your dollars over time. According to the U.S. Department of Labor, the average annual rate of inflation over the past 20 years has been approximately 2.3%. Calculated from the Consumer Price Index data published in the U.S. Department of Labor in January of 2015, that 2.3% annual inflation could cost us $100 today, would actually cost us $158 in 20 years. In all the calculations we've discussed so far, we've ignored inflation. However, when we're talking about our retirement lifestyles, what we're really concerned with is the purchasing power of our retirement investment. That means adjusting our calculations to reflect the impact of inflation, and that impact can be significant. For example, let's say that you invest $5,000 each year for 30 years. If your investments grow at 6% annually, you'll end up with about $395,000. Now assume a 2.3 annual inflation. This means that each annual contribution of $5,000 is actually worth less in terms of today's dollars. It also means that your investment's growth is only outpacing inflation by 3.7%. And in our example, after 30 years, your $395,000 has the purchasing power of only $200,000 in today's dollars. Probably the best way to accumulate funds for retirement is to take advantage of special tax-deferred retirement savings vehicles. A 401k plan and other employer-sponsored retirement plans can be very powerful saving tools because your contributions come out of your salary pre-tax, that is before you pay taxes, reducing your current taxable income, and grow tax-deferred, meaning you do not have to pay taxes on them, until withdrawn. Withdrawals made prior to age 59.5, though, may be subject to an additional 10% penalty. You may also be able to make Roth 401k contributions. Unlike pre-tax contributions, Roth 401k contributions don't provide you with an immediate tax savings, but they allow you to make withdrawals completely free from federal income taxes under certain circumstances. Finally, 401k plans often include employer matching contributions, which should make them your first choice in saving for retirement. Traditional IRAs, like 401ks, feature tax-deferred earnings growth and can lower your current taxable income if you qualify to make tax-deductible contributions. And like a 401k, funds aren't taxed until they're withdrawn and may be subject to an additional 10% penalty, though, if withdrawn before age 59.5. Like Roth 401ks, Roth IRAs don't permit tax-deductible contributions, but they allow you to make completely tax-free withdrawals under certain circumstances. We're going to spend a few moments looking at the impact tax-deferred growth can have, and then we'll talk about 401ks, traditional IRAs, and Roth IRAs in more detail. Let's assume you have $20,000 to invest. You put $10,000 into a taxable account that earns 6% per year and use a portion of these assets to pay taxes attributable to the account's earnings. You put the other $10,000 into a tax-deferred account such as a 401k that earns also 6% a year. Assuming that you're in the 28% tax bracket, in 30 years your taxable account will be worth about $35,500, while your tax-deferred account will be worth over $57,000, and that's a difference of over $21,000. Even if the funds invested in the tax-deferred account are subject to federal income tax upon withdrawal, as they would be if you were made pre-tax contributions to a 401k, you would still come out ahead. This is true even if you took the entire amount in the tax-deferred account as a lump sum distribution after 30 years and paid tax on the full amount, and at 28% tax, you'll end up with a little over $41,000. Of course, most individuals draw on their retirement savings gradually during their retirement years, when they may be in a lower tax bracket rather than taking a large lump sum. Let's look more closely now at IRAs and 401ks. An individual retirement arrangement, which is an IRA, is a personal savings vehicle that offers specific tax benefits. Even if you're contributing to a 401k or other employer-sponsored retirement plan, you should consider an IRA as well. We're going to discuss two types of IRAs, traditional IRAs and Roth IRAs. Both allow you to contribute up to $5,500 in 2016 into Individuals age 50 and older can also make additional catch-up contributions. These folks can put $6,500 into their IRAs for 2016. You can contribute to both a traditional IRA and a Roth IRA, but your total annual contribution cannot exceed these limits. Contribution limits are tied to the cost of living and may increase in upcoming years. Both traditional and Roth IRAs feature tax advantages, and both give you a wide range of investment choices. However, there are important differences between these two types of IRAs, including the specific tax benefits and the qualifications to contribute. You must understand these differences before you can choose the type of IRAs that are best for you. Practically anyone can open and contribute to a traditional IRA. The only requirements are that you have taxable compensation and be under age 70 and a half. The question is whether or not you can deduct your contribution. If neither you nor your spouse is covered by a 401k plan or other type of employer-sponsored retirement plan, you can generally deduct the full amount of your annual contribution. If one of you is covered by such a plan, your ability to deduct contributions depends on your modified adjusted gross income and your income tax filing status. You may qualify for a full deduction, a partial deduction, or no deduction at all. Not everyone can contribute to a Roth IRA, however. Roth IRA contributions are phased out for individuals with higher incomes. Whether you can make a full contribution, a partial contribution, or no contribution depends on your modified adjusted gross income and your income tax filing status. Unlike a traditional IRA, all contributions to a Roth IRA are made with after-tax dollars, and you don't get a deduction for your contributions. With both traditional and Roth IRAs, funds do grow tax-deferred. Now, distributions from a traditional IRA are subject to federal income tax. However, no tax applies to any portion of a distribution that represents non-deductible contributions made to the IRA. In addition to income tax, you may have to pay a 10% early withdrawal penalty if you're under age 59 and a half at the time of the distribution, although a number of exceptions do apply. If you meet certain conditions, your withdrawals from a Roth IRA will be completely free from federal income tax. To qualify, you have to satisfy a 5-year holding requirement, and you generally have to reach age 59 and a half before making the withdrawal. Even if you haven't reached age 59 and a half, you also have to qualify for tax-free treatment if you satisfy the 5-year holding requirement and you make the withdrawal either because of a disability or to pay for certain first-time home buyer expenses. Even non-qualified distributions from a Roth IRA get special tax treatment. Distributions are considered to come from contributions first and from earnings last. Distributions that represent a return on your Roth IRA contributions are free from federal income tax. After you've received all of your contributions back tax-free, any further distribution will represent earnings and will be subject to income tax. And if you're under age 59 and a half, to the additional 10% premature distribution tax, unless an exception applies. Note that special rules may apply when a traditional IRA has been converted to a Roth IRA. We've talked about both traditional and Roth IRAs, but which one should be for your first choice? Sometimes the answer is easy. If you're not able to deduct contributions to a traditional IRA because of your income filing status and the fact that you're covered by an employer-sponsored retirement plan, you're better off with a Roth IRA. But what if you do qualify to make tax-deductible contributions to a traditional IRA? Should you contribute to a traditional IRA and receive a current income tax deduction, or should you make after-tax contributions to a Roth IRA? Most professionals believe that a Roth IRA will give you more bang for your buck in the long run, but it depends on your personal goals, circumstances, and the performance of the investment that you select. A Roth IRA may very well make more sense if you want to minimize taxes during retirement and preserve assets for your beneficiaries. But a traditional deductible IRA may be a better tool if you want to lower your current tax bill while you're still working and you expect to be in a lower tax bracket when you retire. A financial professional or tax advisor can help you pick the right type of IRA for you. The 401k plan has become one of the most popular types of employer-sponsored retirement plans, and for good reason. If you participate in a 401k, you should be taking full advantage by contributing the maximum allowed. In 2016, you can contribute up to $18,000 of your compensation to a 401k plan. If you're age 50 or older, you can make an additional catch-up contribution of $6,000. Your pre-tax contributions are not included in your taxable income for the current year, providing an immediate tax benefit. So if you earned $100,000, but you deferred $18,000 into a 401k plan, you only pay current income tax on $82,000. Both contributions and earnings in your 401k plan grow tax deferred until withdrawn, which, as we've seen, can make a real difference in the amount you can accumulate for retirement. Additionally, many employers match a portion of contributions, and if your employer offers such a match, this is effectively free money. Imagine if I gave you $5 and you gave me back $10. I've now got $5 free money. There are a few disadvantages to contributing to a 401k plan, but you are generally limited to the investment options offered by the plan, and distributions made from a 401k plan prior to age 59 and a half, sometimes age 55 in some circumstances, are subject to an additional 10% premature distribution tax, although a number of exceptions still apply. In addition, access to funds in your 401k plan is generally limited while you're still employed. Your 401k plan may also allow you to make Roth contributions. Like Roth IRA contributions, Roth 401k contributions are made with after-tax dollars, so you don't get an immediate tax savings the way you do with pre-tax contributions. On the other hand, if you meet certain conditions, the earnings in your Roth 401k account are entirely free from federal income tax. Any distribution that represents a return of your own contributions is always tax-free. The limits for Roth 401k contributions are the same as the limits for pre-tax 401k contributions. That is $18,000 for 2016, $24,000 if you're age 50 or older. But the limit applies to your total pre-tax and Roth contributions. For example, you can choose to make $8,000 of pre-tax contributions and $10,000 of Roth contributions, or split your contributions in any other way you wish. In order for a distribution from your Roth 401k account to be tax-free, you have to satisfy a 5-year holding requirement and be either age 59 and a half or disabled when you receive the payment. If you receive a non-qualified distribution, your payment will generally include your own contributions, which are non-taxable, and a pro rata portion of earnings, which are subject to income tax and a potential 10% premature distribution tax, unless you're age 59 and a half and older, or other exception applies. Roth 401k contributions are treated the same as pre-tax contributions for all other 401k plan purposes. For example, access to your funds is generally limited while you're still employed. Your employer can match your Roth 401k contributions, and your plan may allow you to borrow from your Roth 401k account. Like IRAs, whether you should make pre-tax or Roth 401k contributions depends on your personal goals, circumstances, and the performance of the investments you select. Not all 401k plans allow Roth contributions, so check with your 401k plan administrator. While we're not going to discuss specific investment options, I'm going to mention annuities because they're specifically designed as a way to fund retirement. You probably shouldn't consider an annuity, though, unless you're already contributing the maximum to your 401k and IRA each year. An annuity is an investment vehicle contract between you and the annuity provider. Annuities vary when it comes to the details, but they share the same general characteristics. You invest money, either a lump sum or a series of premium payments, with a life insurance company. And in exchange for your investment, the insurance company promises to make payments to you or to a named beneficiary at some point in the future, for example, upon your retirement. Bear in mind that a company's promise and guarantees are dependent on the financial ability of the company to meet its obligations. Like 401ks and IRAs, earnings in an annuity grow tax-deferred. However, unlike 401ks and traditional IRAs, unless an annuity is held within an employer-sponsored retirement plan or IRA, premium payments are made with after-tax dollars. You don't get a tax deduction as you might with a traditional IRA. An annuity may provide a death benefit to your heirs, and there's no limit on the amount you can contribute. Note, however, that insurance features such as a death benefit that are generally accompanied by higher costs. When you take income tax rates, an additional 10% premature distribution tax may also apply if withdrawals are made prior to age 59.5, although some exceptions apply. It's also worth noting that unlike 401ks and traditional IRAs, you don't have to start taking required minimum distributions from an annuity after you reach age 70.5. You generally have a number of options to choose from in terms of how you receive distributions from an annuity. For example, you can typically withdraw funds as you need them, or you can convert the annuity into a guaranteed series of payments that will continue for the rest of your life. Note, however, the guarantee is limited to the claims paying ability of the insurance company. Finally, you need to understand that annuities typically impose a surrender fee in addition to other fees and charges. As I said, we're not going to talk about specific investment options, but it's worth taking a few moments to discuss some general investment considerations related to retirement planning. For most of us, retirement is a long-term goal. This means that generally you should be evaluating investments based on their long-term potential. Try not to overreact to short-term market fluctuations. We all know that there's a relationship between investment risk and potential investment return. Investing primarily in conservative fixed income investments may be appealing because there's relatively little risk that you'll lose money. However, doing so has an opportunity cost. You may miss out on a possible higher long-term growth. And there's a danger that your investments might not sufficiently outpace inflation. Investments such as stocks and mutual funds offer higher growth potential, but with a corresponding increase in risk. So what should you do? You'll want to choose an investment mix that will provide you with the rate of return you need to pursue your accumulation goal in the time you have until retirement while minimizing your overall risk. This means that you should generally opt for a lower risk investment portfolio with the potential to generate the growth you need over a portfolio that offers a higher potential return but at a significantly increased risk. In other words, don't get greedy. Don't risk the retirement you want for the potential to get higher returns than what you really need. In the end, though, the investments you select have to fit your own level of risk tolerance. And you should try to further reduce your level of risk by diversifying your investments both among investment categories, for example, cash vehicles or fixed income investments and equity investments, and within investment categories, for example, large cap stock, small cap stock. Keep in mind, though, that diversification cannot guarantee better investment performance or eliminate the risk of investment losses. Finally, reevaluate on a regular basis and make adjustments as necessary to keep your retirement plan on track. You may find a financial professional invaluable in working within these and through these issues. Up to now, we focused on accumulating the funds you'll need for your retirement. But there's another very important part of planning for retirement, protecting yourself against the possibility that something will adversely affect your finances and devastate your retirement strategy. Insurance companies allow you to plan for the unexpected by shifting financial risks to the insurance company. For most of us, the success or failures of our plan for retirement will depend on our ability to continue to earn a living. If we were unable to work, our ability to invest for retirement would have to be curtailed. It's important to protect this primary income source. Disability income insurance can protect financially against the possibility that you'll be able to work because of illness or injury, replacing a portion of your lost income. Similarly, life insurance can play an important part in your family's overall financial plan. What would the financial impact be on your family if you or your spouse were to die prematurely? Life insurance can ensure that you and your spouse's plan for retirement will survive the death of one of you. And in addition, permanent life insurance has a cash value component that can be withdrawn during retirement as a source of funds. As you approach retirement, you'll have different insurance concerns. In general, you'll want to do everything possible to make sure that you have adequate health insurance coverage. This will be even more critical if you plan on retiring before you qualify for Medicare coverage. In addition, long-term care insurance can help you maintain financial independence by protecting you against the high cost of care should you need to stay in a nursing home for an extended period of time or should you need in-home care. We've reviewed a lot of material over the last half hour. You're going to want to carve out some time and work through your specific situation to come up with your own roadmap to retirement. What's important is that you put a well-thought-out plan in place and stick to it. Start now. We've seen that waiting just makes it more difficult to succeed. Invest regularly, making full use of tax-deferred retirement vehicles like 401ks and IRAs, and choosing investment risks that have the potential to meet your accumulation goal with minimum over-risk. Make sure you have adequate insurance coverage. Protect both your health and your assets. Finally, review your plan on a regular basis and make adjustments as necessary. Remember, your retirement destination should determine your road map, not the other way around. Thank you for your time. You've been a wonderful audience. I would welcome the opportunity to meet individually with each of you to address any specific concerns or questions that you may have. Have a great day.
Well, thank you, Stacy. You've definitely provided us some good information about retirement basics. In the event you have any questions that you'd like to ask Stacy, as a reminder, simply go to our website at ibmsecu.org, click on Services, then Financial Services, and complete the form at the bottom. We'd like to thank you for attending today's session.